Welcome to our last lecture together. So let me first by talking about what you all want to hear first, which is probably the logistics and then topics that you will see on the exam. So let me do that first. So if you check your Canvas or whatever your aims, I'm not exactly sure where you see your calendar, but you should be assigned to one of these classrooms. So just make sure you are assigned to LT1, 3, or 5, which is this building, but one of the classrooms. I think not in. I think this is LT2, right? So the one across the hall and so forth. It's on May 2nd. Everyone's going to take the exam at the same time on a Friday from 6:30 p.m. to 9 p.m. And there will be a total of 8 questions, just like the midterm. So there should be no surprises. You know how it's going to. I mean, the sequence of things that are going to occur when you come in. The only difference, of course, is now you have someone to check your ID. All right, so make sure you bring everything, formalities. Your ID, uh, and, your notes, right? And make sure you show up on time. And you have again around or exactly 3 hours as opposed to 2 hours and 50 minutes to complete your exam, which I hope is more than enough for you guys. All right. Questions about logistics? Okay. So the exam topics are the following. So I believe these numbers should up to 8, right? 2 plus 3 is 5 plus 1, 8, right? 8. There will be 2 questions from the midterm. So midterm topics up to PPP. So you can expect, like the uh, uh, covered interest rate parity arbitrage is fair game, right? PPP, purchasing power parity is fair game, long-term condition. The short-term model, right, where you plot exchange rate against interest rates against money demand, money supply is fair game. All those things, can be tested. So those two questions I leave for you to, to recall a little bit. But I think if you fixed your mistakes on your midterm, you should be pretty much ready to go. There will be 3 questions that will ask you to rely on the AADD or AADDXX model. So again, most likely it will be some shock coming from you read it something in the news, such as like a tariff shock or anything you imagine, price shock. If you're familiar with the equations, right, that represents the A schedule, D schedule, XX schedule, then you can just you just think it through and you know what shifts, you can make those predictions, the mechanisms, then you're again, once you have a mastery of those equations and your deep economic intuition about those equations, you're ready to go. There will be one set of true false questions. So just like the midterm, I could ask you something pre-midterm, but you should expect these true false questions to also include stuff related to blockchain. So anything beyond the scope of the lecture last week, don't worry. I will only test you on any topics that are discussed within the confines of the slides. So even stuff on the video about hash, those signature functions, whatever, I'm not going to test you on this. As long as you have a basic understanding of what blockchain is, how Bitcoin is, what Bitcoin is, how is Bitcoin, why is Bitcoin useful, and to some extent, how the relevant of blockchain and the use of finance, such as fundraising, etc. Just some background knowledge is good enough. You're not expected to know any technical details of consensus algorithms or whatever. It's not necessary. So of course, I only mentioned the Nakamoto consensus, right? That's the only thing you need to know. The proof of work, right? If you understand proof of work, that's all you need. Okay. And then the final 2 questions, there will be related to risk management. So that's like, I want to be exposed to this price fluctuation. I don't want to be exposed to this price, below this threshold. How do I construct a portfolio of options so that I get exactly what I want, right? The exact exposure. So if you understand how to make a payoff table, you know how to plot the gross payoff and the payoff that includes the cost of the portfolio, then you're good. I have two examples in my practice problems here for you. So just in case, but again, the first source you should reach is the lecture from last week or 2 weeks ago. And again, if you're comfortable with making the tables and plotting, then you should be ready to go. Again, I'm not asking you to memorize anything here in this class, right? So it's again just your conceptual understanding is more important than anything else. And then you have your notes just in case if you really need to recall some specific fact. Again, I'm not going to test you on it. What's important again is economic intuition. All right, questions, comments, topics. So again, I think this narrows down the stuff you need to prepare, right? There's not too much stuff beyond. There's not going to be anything other than these things. So hopefully this reduces the things you need to study. All right, my plan today is to go over some practice problems, but how far we get depends entirely on you. I'm going to try to do something where I'm going to ask you, the audience, to do it rather than I just walking through it. I'm going to ask you to, tell me what to do next. Okay, so there will, of course, will be a prompt, and you need to tell me what sort of information is important and what can you analyze based on what's presented to you, and then you tell me what to do in terms of plotting, etc. Okay, or explaining the phenomena that you observe. Okay, so before I do that, let me give you kind of just a broad conceptual understanding of what you should take away from this class. So from week 1 and week 2, the number one thing that you should come out of this class is you have a better understanding of what money is. So I don't know what your conceptual understanding of money is. Maybe you thought of it was like gold or something, like it's something you hoard, right? And has intrinsic value. And of course, that's not what we learned in this class. The first thing we learned is that money is an extension of credit, right? It should be thought of like a debt contract, right? That the debt contract that you're lending to a government, that governments and nations are lending to each other, and that's what facilitates trade, right? You need this network of trust, and that's represented through money. So money essentially is a social construct, right? It's an extension of ourselves, and therefore it has value because we trust each other. And that trust allows us to make trade, and trade is what gives money value. Okay, so that's number one, like a philosophical understanding of what money is. Number two, you learn that FX rates can be modeled rigorously and related to interest rates, price levels, and commodity flows, flows of commodity and including services too. Okay. So we borrowed stuff from macroeconomics, we borrowed some stuff from just finance, basic finance, like the future swap parity. And this allows us to tie everything together, right? And that's represented by the AADDXX schedule that I hope that you just take with you when you watch the news. That's something you should be thinking in the back of your head. And of course, the more you see it, the more you apply it, the faster you are. And thinking about or realizing what these guys are on TV are really talking about. All right. Number 3 is that FX rates play a role in monetary and fiscal policy. So all that stuff about discussions about the economy, interest rates, inflation rates, blah, blah, blah. It's all related. Okay. It's important and it plays a role. And in fact, many countries try to take advantage of FX rates to boost their economy. But what you learn from this class is that there is a structural connection, right, between monetary policy, fiscal policy, and exchange rates. They help each other, right? Well, sometimes they hurt each other, but there are different, of course, strategies that central banks and governments can adopt to, augment their output effect, right? Which is ultimately what governments want to do. They want to protect their economy from a recession. They want to boost their economy. They want to grow. They want to transition from emerging to a developed country. This is all very important and also ultimately related to exchange rates. Okay. And lastly, from the last 2 or 3 weeks, right? We talked about managing exchange rates. Again, it's an applied topic because this stuff you can pick up very easily in your derivatives class, but now you have a pretty much hopefully a solid understanding of where FX rates will come from, right? It's because most of the time as businesses, your income that you generate from a different country could fluctuate in value, and you need to hedge against that, right? That's probably the most fundamental risk management problem you'll face if you work for an international company, like a global conglomerate, for example. How do you deal with different currencies which can change in value over time? And how do you pinpoint exactly the kind of price exposure that you want, right? Using derivatives and using options, forwards, futures, swaps, etc. Okay. And of course, we talked a little bit about pricing, but again, intuition is more important if you really want to know the rigor you need to take, a derivatives class standalone. Okay, so that's what we did for the past 12 to 13 weeks. So I hope that's what you carry with you out of this class. All right. So my goal here is to show you, at least convince you, that the stuff that we learn in this class is relevant to everyday life of people who are work on Wall Street, work in Hong Kong in the finance sector, work in Shanghai, Beijing, whatever. They have these Bloomberg on all the time, and then they have these pundits or analysts that just talk endlessly. And I want to at least convince you at the end of this review session that you should have a better understanding what they're talking about now. Okay, so I'm gonna in the first, I guess, 3/4 of the questions I'm gonna go over, I'm just gonna show you the news clips. Okay, news clips of CNBC, Bloomberg, and I want you to just ponder about what they're talking about, and then just maybe hopefully have a discussion, and then of course we'll answer some questions that we can hopefully extract from what they're saying to one another. So depending on how quickly we progress, we may not cover everything, but if nobody talks, then I may ultimately just carry to the end. Okay. But anyways, it's probably more interesting if you guys talk. All right, so let's start with the first problem. So here I have a news clip from Bloomberg News in October 2019. Right. So maybe some context here. This is talking about the rise of the strengthening of the Thai baht, because I guess a lot of Chinese people wanted to travel during this time, and this Thai baht is getting stronger, and people were asking, what do you think the Thai government's going to do about the strong Thai baht? And based on what this director of foreign exchange from, I don't forget which Citibank, I think, we may, the things that they say may not maybe very vague, but I assure you that there's a connection with what he says with models that we learned in this class. All right, so let me start by giving you this clip.
The Thai baht, something a conversation started here in China amongst people looking maybe to travel to Thailand. It's putting them off. You're seeing that impacting tourism flows, but of course exports as well for Thailand. Does the Bank of Thailand have to intervene, do you think?
Look, I think they're obviously concerned about the relative strength of the Thai baht, but I think they also recognize that there's relatively little that they can do about it. They can intervene, of course, but I think they have one eye on sort of the intervention criteria from the US Treasury. They can sort of encourage more capital outflows to try and weaken the baht, but that's a very slow-moving process. And I think they'd be very reluctant to go down the path of any sort of capital controls to prevent inflows to limit the strength of the baht. So I think in some ways they'll probably cut rates. We do expect the Bank of Thailand to cut rates, but I don't think they'll do anything beyond that to try and weaken the baht. And I think for the time being, given their very large current account surplus, they probably have to tolerate a stronger currency for the time being.
And you were talking about earlier about 2020 might be the year when the dollar finally kind of breaks down, we're gonna get lower. How do you fade that dollar strength then? What do you actually buy? And how do you position?
Yeah, so I mean, the preferred trade for me always this year and going to next year is to be short dollar yen. We have a forecast of dollar yen moving close to 100 over the next several months. So I think that's kind of the best risk reward trade because it benefits from a risk off. Japanese flows we think will be supportive for the yen, and of course the dollar weakens, that helps. But I think the real question is at what point do you position for a weaker dollar versus Asian currencies? And again, I think the preference for me would be to be short dollars versus low yielding Asian currencies, things like the Thai baht, maybe the Korean won at some point if we see a resolution in US-China trade tensions. But we have to wait for that to happen before we do that.
All right. Any comments or something you want to discuss that you got from that video? So there are, I think, at least two topics, I think. Number one was a discussion about what the Thai government or central bank was going to do about the strong currency. And he gave some, I guess, how do you say, obvious responses. And so that's number one. Number two, he talked about, someone asked about the strength of the US dollar or and then his response was strange, all right? He was talking about shorting the dollar and then going long on Asian currencies, right? So like, I think he kind of redirected the question to something else, but in any case, we can talk a little bit about that. So is there anything that stands out to be confusing? That's my first question, I guess. All right, well, okay. So let me just pose a question then, and then hopefully somebody will answer. So he talked about capital inflows and outflows, but and then he proposed something about whether or not the central bank was going to cut rates. So maybe somebody can tell me how monetary policy can actually facilitate capital outflows. Even though he said it's slow moving, right? He said something about slow moving, but can somebody explain to me? So here, I'm not gonna move on until somebody says something. Okay. Any ideas? All right, so first let me ask you, what's a capital outflow? Or tell me what's a capital inflow? All right, somebody from the first row. You have an answer? No? You? Right, exactly. So what kind of monetary policy can facilitate an outflow though? Very good. How? Very good. Right. So outflow would be what then? The opposite, right? So what's the opposite? So very good. So is that hard? So help me and then you help yourselves. Okay, good. So whatever he said, that, I guess he's Morgan Stanley, right? Forget. Anyways, well, he was just talking about capital inflows, capital outflows, and then he proposed, interest rate cuts. That's exactly, what he's, what he was discussed previously. So, indeed, if the central bank cut interest rates, that will disincentivize people from investing in Bangkok and move their money elsewhere. So there is a capital outflow effect from simply monetary policy, conducting expansionary monetary policy, right? So remember, right? If you disincentivize people by reducing the opportunity cost, then people will move their money. They'll hold cash, or they'll move their cash to some other country. If they do that through interest, they can do that through interest rates. So if interest rates are reduced because they've conducted monetary expansion, and of course, that will lead to actually what? Depreciation, right? Of the Thai baht. Right. So you can, right? So I guess the question therefore is if they keep the money, right, in Thailand, if they're just moving from Thailand bonds to Thai stock, right, it's still in Thailand. But I imagine there will be some people who move the their money from Thai to some other currency with higher yielding bank deposits, right? So under those circumstances, there could be a capital outflow. Very good. Second question, there was a discussion about tourism, right, in the beginning. Can someone explain to me how tourism can affect the current account? So again, just think about it from, here's a hint, right? Here's the hint. The current account is approximately equal to EX minus NN. So if someone explains to me how the current account is affected by tourism. Someone from the back row, right underneath the projectors. Nobody? Souvenirs? Yes, sure. Yes, very good. So when you have tourists coming into your country, essentially and they spend money in your country, right? Exactly. It's an export of service. Very good. Tourism is an export of services, right? Mostly, right? Because of course, if you buy stuff, it's also an export, right? It's a one person or one group of people buying, right? But what do you think export is on a massive scale, right? It's a company coming into your country and spending millions and billions of dollars. But tourists is almost the same thing, right? But it's just one person or a group of people spending a smaller quantity of money for goods and services. So it's the same thing, right? But that's right, exactly. Okay, so very nice. We have solid understanding. Good job. So let's try to think about this. Let's try to think about what the problem is from Thailand's perspective. So there was a discussion, right, mentioned that Thailand had to tolerate a strong baht. So we kind of want to show that they tolerate it because even with this demand shock, they are satisfying like a current account target. Can we show that with this graph, right? That's kind of what we want to see. So let me start by plotting what I want to see. I want to know exactly what happens in this graph. And hopefully you can give me some ideas of how to move, how to progress. Okay. And of course, we have an X curve. Let me just write the starting point. And then. So the first thing I want you to think about is how to interpret a positive demand shock, right? So let me write the equation here. The relevant equation here. Make it smaller. So notice that I wrote out the entire current account parameter because I want you to interpret this demand shock coming from a change in the current account, meaning that perhaps that the Thai current account is now more responsive, right, to changes in Q because of this higher demand for tourism, right? So tell me how to show the effects of a sudden positive demand shock that's coming from a change in the current account function. Somebody will start me out. What's step one? Okay, so one more thing, there's another relevant equation, right? It's CAT equals to CA y minus T Q y minus T. So again, I'm giving you hints here, right? If the change is going to occur with CA, then the change is going to be also here, but remember that our target hasn't changed yet. So so that means the X curve will change, but will still satisfy a target. All right, somebody start me off. Which curve changes first in response to a demand shock coming from CA? So what I'm saying is perhaps CA changed such that CA prime is greater than CA, right? So what happens? You can pull up your slides if you're unsure, but it's in the slides. All right. So I'll start you off. Okay. If the current account increases And we're holding E constant, right? So let's just hold it constant here. If the current account increases, then the entire aggregate demand function will increase, which means that output will increase. So for any given E, if there's a higher, more responsive current account, then there should be a higher output as a result. And therefore, the DD schedule should shift left or right. Yes, very good. So, like that. Okay, so I apologize for my drawing, but hopefully your drawings are better. Okay. All right, but we're not done, right? Because the current account equation change also changes with the XX schedule. So how does that change? All right, so I'll do this one. The next ones is it's up to you, okay? So if the current account now is higher, so it's like this, right? It's higher. For a given output, so let's hold output constant, then E has to move in such a way that lowers the CA, right? And so that means that E has to decrease, right? So if we're getting a given output, we must have a lower X, right? In fact, because the current account is part of the aggregate demand function, it has to move together. So in fact, it should move like here. Okay. So all that discussion in the video about the current account surplus, right? And Thailand had to tolerate a stronger baht is precisely because given its strong baht, it's still satisfying its goal, right? Of hitting that target. The target is not moving, right? I haven't changed the left-hand side of that equation. What has changed was the responsiveness of the current account with respect to changes in Q and disposable income, right? Because of that sudden shock, consumption shock, right? Demand, export shock, right? From tourism coming from China and elsewhere. And so the X curve, because again, is part of the aggregate demand function, has to move together. And so even though, you know, DD schedule shifts to the right, XS also has to move to the right, so to speak. Okay, so the final, of course, resting spot is exactly as you expect. You get a stronger baht, right? And a higher output. Well, of course, that's not necessarily good because if you're, again, an emergent economy like Thailand and you're export driven, this is not a good environment, right? This is not a strong baht is not good for you. So the conclusion here is most likely hitting their current account target, so tolerate a stronger baht. All right. So the last discussion, the last things that was talked about in that short video clip is how does a resolution of the US-China trade tensions help a short US dollar SKW stands for South Korean won carry trade, right? That's what we was talking about, the short dollar won trade. He's talking about a carry trade. And so there's an implicit exposure. And so let me write the equation down, the relevant equation, and somebody tell me so presumably, if you do a short dollar South Korean won trade, this is true. And this is USD deposit. And this is SKW. Deposit. And based on this equation, you are hoping that this is not too negative, right? Or very negative. So someone please tell me how this statement, resolution of US-China trade relations will impact this equation here. How will it help my trade? Just read the math, right? What changes from this equation, which will increase my profits, right? If it's violated, of course, I'm expecting positive profits, but how do I increase that expectations? What changes here because of this? That's my question. What variable changes if this? Okay, here's the hint. Okay, what variable changes if beliefs about resolution of US trade relation? If there are beliefs about resolution. Okay, so that's somebody just yell out the answer. Expectations, right? If expectations about a resolution of US-China trade tensions increase, right? Then we should expect higher demand for Chinese yuan in the future, which could spill over to demand for the South Korean won, right? And so which direction will EHAE increase, given that I formulated this equation here in such a way that R is US dollars? Which I just told you which currency gets stronger. So which direction does EHAE change? All right. Okay, so here's a logic change, right? Resolution of US-China trade tensions means no more uncertainty, right, about additional tariffs and whatever. Higher demand for Chinese goods, which means that SKY could be positively correlated, right? That means that higher demand for SKW and expectations, right? So EHAE should increase, right? Because I defined R as dollars, US dollars, right? So that means if EHAE increases, dollars get weaker, South Korean won gets stronger. And if there's a stronger South Korean won in the future, then EHAE minus E is less negative, right? Or more, it's more positive, right? And more positive will increase my expected profits from carry trade, right? So obviously, right, on average, this should be zero. I mean, this should be a negative number, right? Eventually, right? This should be a negative number because ours, if this is greater, if R star is greater than R, then this should be a negative number. But if expectations get larger, then this is more positive, and therefore the entire right-hand side is increasing, right? Therefore, my expected profits from carry trade is increasing from this short dollar trade, right? Make sense? So, do you now see that everything that was taught in this class is just, people just, say it within, that was just 2 minutes, okay? Within 2 minutes, he said all these things, right? And it took a while to digest it, right? But you should be faster once you watch enough of this television. Okay, so that's the first clip. Any questions on that clip? Is there anything that didn't make any sense? So if you really want to get, so the takeaway here, right? If you really want to get good at this class, just watch Bloomberg nonstop, especially when they talk about FX rates. And this is just, they're basically saying the same thing over and over again. And then you'll just realize that, oh, I know this. This is from this and this. Okay. Anyways, this new clip, this other clip is from 4 years prior to this one. So this is 2019, this is 2015. So maybe you already know what this clip is about. 2015, there was a evaluation of the Chinese yuan, and the Wall Street Journal reported on this. So it will, talk about it, and maybe you have some recall about it because you heard about it, because you lost a lot of, your money lost a lot of value that day.
China shocked the world with a major devaluation of its currency in a move that's going to have effect on both investors and politicians. We're the Heard on the Street team in Hong Kong, and with me is Aaron Back. Aaron, are you as surprised with the move as everyone else is?
I'm quite surprised, yes, but in retrospect, it does have a certain amount of logic. The Chinese economy has been weak and getting weaker. They need to loosen policy, but they're in a bind because when they cut interest rates, that creates outflow pressures, especially when the Federal Reserve is expected to soon start raising rates. And so this is, in a sense, their solution to that.
And we have to note here that, for a while, China has evaded this sort of what economists call the trilemma in monetary policy by having a closed capital account. But that's not true anymore, right?
Correct. I mean, the Chinese capital account is sort of semi-open. It's open enough that we've seen actually hundreds of billions of dollars of capital outflows in the first half of this year. And so, that's why they're doing this now. They can't keep the currency stable and cut interest rates at the same time because it just sends too much money out.
So even though this is supposed to show some kind of deep malaise in the economy, investors so far seem to be reacting pretty well, at least in the stock market. A lot of stocks are up. What do you make of that?
I mean, I think stock market investors view this as a form of easing, and in a sense, that's true. And they, perceive that this will pave the way for further interest rate cuts as well.
Yeah, if I'm holding, stock in an exporting company, obviously I'm better off now because exports are really going to go through the roof.
Yeah, a Chinese exporter, sure. But if you own stock in anyone who sells something to China, like a raw material producer, then this is quite negative for you. So I do think that, the market is going to have to sort of settle out the winners and losers here. That's only just started.
The other question here is politics, and for a while it's U.S. election season, and politicians in the U.S. for the last many years have been beating the drum about China as a current currency manipulator. This is obviously going to change the debate and the tone in the U.S. now.
Yeah, maybe. I mean, I think in a sense, China's timing is good here because you actually hear a lot less about China being a currency manipulator than you did, say, in 2008. And that's partially because the renminbi, over those years has appreciated quite a lot. Now, we have a presidential race coming up. Wouldn't be surprised if we hear Donald Trump talk about this, but it's not as big a deal as it was several years ago.
All right, maybe another campaign talking point for Donald Trump, but certainly an issue for investors to grapple with.
So, how this discussion was relevant to our course, because we talked about the policy trilemma, right? You have to choose two out of the three, right? The three choices was stable prices, right? In other words, stable exchange rates, independent monetary policy, and lastly, free capital flows. And they were talking about how China is pretty much quasi open now in terms of its capital flows. And so if they wanted to, how you say, maintain price stability, it's impossible now, right? And that's what I'm going to ask you. I want you to show that that the policy trilemma is true. Yeah. But we kind of want to know the direction. What's the direction of the exchange rates? And what are the options exchange rates want to move given this the current situation of China at that time, which is like a economic slowdown, right? And also, what are the options they have to kind of, if they wanted to maintain, for example, a stable exchange rate, what could they do instead of monetary policy, right? Okay, so let's look at my first question for you. So I want you to use, you don't have to use the XX here, so maybe just the AADD. Use the AADD diagram to show the effects of a negative household consumption shock on the Chinese economy. So don't think about price stability mandate. Don't think about any sort of response to counteract this consumption shock. Let's just assume that people are now fearful, right, of a potential recession, and now they're more prone to saving, and therefore consumption is declining, right? So the relevant equation you should be thinking about, therefore, is the following, right? Aggregate demand is a function of consumption, so consumption is changing. And of course, we can still write account equation out. So I want you to think about this. Okay. All right, so let me draw the graph, and then hopefully somebody will help me out. All right. Help me out, somebody. What happens to the DD schedule? All right, yeah. I just told you. What happens to the DD schedule? Very good. It will shift left. Right? Because this goes down, it changes, it's less responsive to domestic income, aggregate demand falls, therefore output falls, and I'm holding E the whole time, so aggregate demand function shifts to the left. Good. All right, cool. So next question. In the same diagram, show the effects of the Federal Reserve raising interest rates. Again, no need to assume that it's permanent, just assume, just say they do a temporary case. There was a discussion of the Federal Reserve doing something, right? They're doing the opposite of what China was doing back then, right? Because there was, I think, not inflation, but I think they were trying to get out of the zero bound, right? Period. You're trying to move away from zero, near the zero lower bound. And so interest rates were actually rising back then. So, here, I want you to see the effects of Federal Reserve increasing interest rates. So all I'm doing is just drawing the stuff we saw in the previous graph, okay? Fine. Okay, tell me what happens to this graph when the Federal Reserve increases interest rates. So, okay, forgot to write, to be clear, right? This is equal to USD slash CNY, okay? There, right there. Hint, right? Hint, MSAA is MS over P equals to L R star, hint R star. And E over E minus one Y. Okay. Okay, so maybe I'll write MS star will what? Increase or decrease? If US wants to increase interest rates, how do they do it? Very good. All right, so decrease money supply, that will increase interest rates. And then increasing interest rates will distort UIP. Oh, it's R star, sorry. R star, which will distort UIP in this way. Okay, someone tell me what happens to E prime. Okay. What happens to E? Yes, increase. Therefore, increase E. So the A schedule will shift up, right? Because for any Y, right, for any Y, given this monetary contraction by the US central bank, we must have a higher AA. All right, so you can kind of already see why China wants to devalue, right? Because if they didn't, it would be devalued anyways, right? So they've already pretty much, basically what they want to do is already what's going to happen, right? So let me show you that this is the original. This is the original, we're out here, which is, all right, we already experienced a shock here. But then we have AA also shifting up, so it looks like E is also still higher, right? So you have upward pressure, right, on E coming from the consumption shock, but you also have upward pressure on E coming from the Federal Reserve raising interest rates. So you have two effects, wants to push E naught upwards. All right. Is that clear? All right, that's the takeaway so far, right? In the absence of wanting price stability, or they call it devaluation, but according to them, right, they're quasi open terms of their capital flows. So whatever happens, if they did nothing, E has to increase, right? And so there will be, this is coming, right? All right. Show what happens when PBOC devalues CNY via expansionary policy, monetary policy from the baseline. So let's assume that we are here. Okay, this is the baseline. What happens after monetary policy? What happens after expansionary monetary policy to so-called devalue currency? So let's see, where are we now? We're here. Oh, my bad, not this one. This one should be up here. Maybe this. Okay. All right, so the objective by the PBOC is to devalue the currency. Let's suppose that they want to devalue the currency such that there is an output shock that's at least the same as where we started from prior to the consumption shock. So what has to change from AA? So let's just walk me through it. This is easy, right? So increase in MS will lead to what? What happens to interest rates? Yes. Which makes R less than R star plus this. Okay, what happens to E? Very good. And if according to this graph, we want to go back to why not, right? If we want to just go back here, then AA has to ship up to maybe here. Right, but it can be beyond that if they want to go, if they want to boost output, but let's just suppose they just want to keep things the same. Then the effects on exchange rate is here, right? E3. So E1, E2, E3, all above E0, right? You have basically if they want to fix the output, they can. They move the AA schedule, but output would be, of course, back to normal, but you have to get devaluation or depreciation. The US increasing interest rates, depreciation. Consumption shock, depreciation, right? So everything is pushing the Chinese yuan towards depreciation. So why can't China keep currency stable and cut interest rates at the same time? Well, just look at this graph, right? If you want to stay here, right? If you want to stay here and outputs out here, you would need to do, you can't do it with monetary policy, right? Because you get a negative output. So I guess you can, right? But you would have to move it in the other direction. Monetary policy tool is not well suited because you would need to incur a negative output shock to keep Chinese yuan stable. Right, you can hopefully you see that with this graph, right? Everything's pushing E up, right? Demand's pushing it. AA schedule is always moving up no matter what. So the only really option to keep Chinese yuan stable, therefore, is not monetary policy, it's what? Based on this graph. So how do I restore output and maintain this given this graph? what's my other alternative besides monetary policy? So let me say it again, you want to keep exchange rates roughly the same as before. Monetary policy is not well suited because it wants to push if you try to contract, you will incur an negative output effect. So it's not ideal. That's the only way to get stable exchange rates. But there is another way based on this graph, right? Do you see it? It doesn't concern the AA schedule. So propose something to me. This graph has to move, right? DD prime, is there a way to move it back? Right? If you can, it works, right? So if you have, that's something that wasn't really discussed, right? Interestingly, maybe you can tell me otherwise, but what's the barriers for implementing fiscal expansion, right? The problem was that there was a general slowdown, right, in the economy. But you want to keep exchange rates stable. You don't want to devalue it. Why not try to move the DD schedule back? Because monetary policy would move this upward, right? Downward is not an option. That would make things worse. So why not this? Why not fiscal expansion? So you could decrease taxes, right? That's a tax cut. Can someone maybe, I don't know, can someone tell me why that's such a controversial thing? I don't know. I think many people are asking, why don't they give you stimulus checks, right? That's an obvious solution. Otherwise, you can increase government spending. And that would move DD schedule rightward, right? According to our model. So the answer is yes. Yes. Is positive output still USD CNY possible? Yes. You just try to undo the shift in the DD schedule. All right, comments, questions, something that's confusing? Was there something confusing about the video that I can help answer? I think all this was very, very fitting, right? It fit within our framework quite well. We wanted to understand China pre-post relaxing their capital flows. There was a discussion about China, being surprised that China wanted to devalue their currency because they've been doing the opposite for quite a while. And we understand that actually their devaluation is not too surprising because it's pretty much their only choice, right? Assuming that fiscal expansion is not on the table. I guess there's various problems of implementation. So if all you have is monetary policy, then obviously what they're doing is pretty much the only thing they can do. Any questions? Otherwise, I'll move on to the next one. All right, the next one. This is a recent news. This is 2025. So obviously this is related to the current trade war, tariff wars. Okay. This is ABC News. This guy is National Economic Council economist. So he's the chief advisor, I believe. Economist. Okay. So let's give a listen.
So just quickly before you go, I want to ask you about something Treasury Secretary Bessent said. He said that, this is a quote, access to cheap goods is not the essence of the American dream. Is he suggesting essentially that higher prices are not a problem if the end result is more higher paying, good American jobs?
Look, let's think about it just the way we would do it in Econ 101. If I buy a Mercedes, then it goes into consumption. So say $100,000 for a Mercedes goes into consumption, but then it comes out of imports. And so it has no effect on GDP. And a lot of times when we're thinking about the welfare of Americans, we're thinking about GDP per the number of Americans per capita. If you buy a Buick, then it goes into consumption, but it doesn't come out of imports. And so it goes into GDP. That's what the D is, it's domestic production. And so if you want to increase the welfare of Americans, then it's better to have the stuff produced here. And that's a very, very simple fact that the president is pushing very
Okay.
hard.
All right, Kevin Hassett, I really appreciate you. Great to be with us this morning. Thank you very much.
Oh, maybe that was hard to hear. Maybe I'll play it again. So 1 minute.
So just quickly before you go, I want to ask you about something Treasury Secretary Bessent said. He said that, this is a quote, access to cheap goods is not the essence of the American dream. Is he suggesting essentially that higher prices are not a problem if the end result is more higher paying, good American jobs?
Look, let's think about it just the way we would do it in Econ 101. If I buy a Mercedes, then it goes into consumption. So say $100,000 for a Mercedes goes into consumption, but then it comes out of imports. And so it has no effect on GDP. And a lot of times when we're thinking about the welfare of Americans, we're thinking about GDP per the number of Americans per capita. If you buy a Buick, then it goes into consumption, but it doesn't come out of imports. And so it goes into GDP. That's what the D is, it's domestic production. And so if you want to increase the welfare of Americans, then it's better to have the stuff produced here. And that's a very, very simple fact that the president is pushing very hard.
All right, Kevin Hassett, I really appreciate you. Great to be with us this morning. Thank you very much.
Okay, he's basically making a very strong assumption. So maybe you caught it the second time of hearing it. But so let me pose this question for you. Explain. So this guy's name is Kevin Hassett. Okay, that was the guy who was talking. He was suggesting that if there were trade barriers in place, people will find perfect substitutes in which consumption stays the same, but somehow imports effect on demand as a zero impact on GDP or GNP. It doesn't matter here, okay? So let me write the equation down so that you can see what he's saying. I'll just write CH to avoid confusion. Okay? All right. So I'll do this part because you probably didn't catch everything. So before the pandemic, before the trade tariffs that were in place, people imported Mercedes cars. Okay. And if you import stuff, that will go into the GDP or GNP equation in two ways. If I import Mercedes, consumption increases, but that will be mitigated by the fact that imports also rise, right? So these two things net out approximately, right? That's what's claimed. So claim number one. The claim number one, if people import Mercedes, which is a German car, into the US, consumption increases, but so does imports, which has a approximately net zero impact on GDP, right? Claim two. Claim two, if there are trade barriers in place, there will still be an increase in consumption, which is very strong. But suppose there are perfect substitutes for buying Mercedes cars. I don't know what a locally, he's in Buick. Buick is a relatively crappier car, okay, than Mercedes. I think that's indisputable here, right? Mercedes is clearly superior. But suppose Buick is perfect substitutes, then consumption increases, yet there's no import effect, right? And so that's going to have a positive increase in GDP. So assumptions. One, perfect substitution between Mercedes and Buicks. Two, no FX effects from fewer euro demand. Right, you see that? This is like probably a critical assumption here. How do you import stuff? You have to use your dollars, domestic currency, to buy euros, and use those euros to buy Mercedes, and then import them to the US. So there is a residual, there's a secondary effect, right? Because you create pressure on the euro, right? Appreciating pressure on the euro when you buy these Mercedes. But with trade barriers, there's now a lack of supply for dollars in the FX market. So how should dollars move now, given that there's fewer dollars in the FX market? So my question for you is, does USD appreciate or depreciate given trade barriers on importing Mercedes? I just told you the answer, but I just want someone to say it. So let me walk you through the logic again, right? If before the tariffs, I want to import Mercedes cars, assuming I'm in the US. I bring my dollars to the FX market, I sell the dollars, I buy the euros, I use the euros to buy a Mercedes, I import. Right? Now, after trade barriers, the argument is that I'm just gonna buy Buicks. I don't know. And that's gonna boost my GDP. But I'm ignoring something here, that I am not doing the intermediary step in which I am supplying the FX market with dollars. So if I no longer do that, is the dollar going to appreciate or appreciate given the trade barriers? Anybody? There's only two answers here. If you're wrong, it's the other one. So if I'm no longer bringing dollars to sell, then given the trade barriers, dollars should appreciate, right? Because I'm not selling dollars for euros anymore, right? Because it's too expensive. Mercedes are too expensive. I'm not bringing my dollars to the market anymore. I'm not selling them. So it's going to appreciate. So the claim that GDP necessarily increases is not obvious anymore, because with a stronger dollar, there could be now a current account effect, right? we didn't think about. So let's talk about that. Does GDP necessarily increase from Hassett's example? And we can use the ADD diagram to analyze this, but I already gave you the answer with this hint, right? Given that the trade years are expected to go up or has already gone up, dollars are expected to appreciate. So E is going to decrease, right? So what happens? E, Y, E, E. All right, what happens? I can tell you the relevant equation. That's gonna MS or P equals L star plus E hat E. All right, what happens? Which curve shifts? Given that E hat E decreases. Okay. If E hat E decreases, that distorts UIP, right? Such that right hand side is more positive. Right. UIP needs to be restored, so I could increase. Sorry. Yes, yes. Decrease in, yes, decreases are, yes, which will increase L, then we need to undo it. And so what will undo it is if I find a way to increase R, and that's only if E decreases, right? And so the entire A schedule shifts downward because I hold Y constant. And well, guess what? If E decreases, there's an export effect, right? So it's not obvious to me that GDP increases. In fact, this can be significant, right? This delta Y is negative, right? So why I think this effect is very large relative to Mercedes is because the change in E affects all goods and services, right? It's not just restricted to just one specific industry like cars. If there's enough volume of trade of lack of flow of US dollars into FX market, then the dollar is going to get stronger for sure. But that's going to permeate through all industries, right? Through the dollar appreciation. And so I imagine the change in Y can be fairly significant just for protecting, Buicks in the US. So the conclusion here is that GDP shrinks, right? Shrinks. So it's not necessarily a net positive effect from raising trade barriers. So what this takeaway is, this problem is that now you have tools to see if what people say on TV is BS, right? he makes a claim that, oh, if I just put up barriers, people just don't buy imported goods. We can mechanically raise GDP, right? Because according to the equation, consumption goes up, but imports doesn't. Well, guess what? He didn't think about the current account effect, right? And now you have tools at your disposal to kind of realize that the answer is not so clear. And what he's saying is kind of misleading, right? Okay. There's two more, but let's do one and then take a break. So this one, what's this one about? All right, this one is about the Swiss National Bank. So between 2011 and 2014, between 2011 and 2014, I believe the Swiss bank pegged their currency to the euro. I believe 1 to 1.2. Okay, and the reason for I guess if you believe in those stereotypes, yes, Swiss assets are usually regarded as very safe, and so but there's a downside to having safe haven assets. If you have safe haven assets, it's almost impossible to use monetary policy to boost your exports, right? Because everybody's just making the Swiss franc as strong as possible all the time. Okay, anyways, that's the context. Do you want me to play this for you?
The Swiss National Bank shocked everyone. Here's what happened. It's abandoning its policy of The Swiss National Bank shocked everyone. Here's what happened. It's abandoning its policy of a 120 floor for the currency against the euro. That peg was put in place a few years ago to keep the Swiss franc from getting too strong, hurting Swiss exports, a key part of that country's economy. This all goes back to the European debt crisis. People couldn't get enough francs. So why get rid of it? Well, it's becoming very costly for the Swiss National Bank, wreaking havoc on its balance sheet as they built up more than 500 billion francs in reserves just having to defend it. But why now? That's the interesting part. Many suspect it's because the European Central Bank is about to pull the trigger for QE or stimulus. That would only lead to more money rushing out of the euro and piling into the Swiss franc. There's also been a rush lately into Swiss francs on that mass exodus from the Russian ruble. All of this would make it much more difficult and much more expensive for the Swiss Central Bank to defend the peg that it promised to defend. So it scrapped it. The view is the central bank did not want to risk its credibility or spend hundreds of billions more to keep the level in place. The central bank communicated, bottom line, a clear message to the markets, and that is you are in control of this currency. And guess what? The markets took control. The Swiss franc jumped as much as 30%. That is unprecedented and awfully painful if you're a Swiss exporter like Nestle. It also causes ripple effects across markets and economies in the world.
Okay. So this one is a fairly easy question, I think. This is just a classic peg question. So if the European Central Bank, ECB, decided to conduct quantitative easing, so quantitative easing just means large-scale asset purchases to inject liquidity into the system. So open market operations, but massive size. And we should expect interest rates to fall. They're flooding the market with euros. So in response to that, if they decided to keep the peg the same with euro, they're going to defend the 1.2 to 1 peg. What should they do? So let me get you started. Okay, so tell me first what happens when ECB conducts QE? What's the first thing that happens? What shifts when ECB conducts QE? Our, our star is going to decrease, right? Tell me what happens to E. Okay, so for, sorry, this is, this is Euro slash Swiss franc. Okay, so we're talking about, we're taking the perspective of Switzerland. Okay, so our star is Euro. So what happens? R, no, star prime, okay? So it seems that E has to move downwards, right? So let's go ahead. So for a given Y, if ECB decides to conduct QE, that really screws things up for me. Swiss National Bank, that's gonna make my Swiss franc super strong. I don't like. So if the Swiss bank wants to restore the peg, what would it do? It has to do what? Tell me what it does first, and then tell me what changes in the graph. I mean, this you shift it back, right? So it's obvious, you gotta move it back, but tell me how. They increase, right? They gotta increase money supply. So they gotta print more Swiss francs, print more CHF, right? They have to enlarge their balance sheet much more. Okay, so this question is a bit harder, but I think you can do it. So given that ECB has a bunch of countries within their group of their collection, some of them are near default on their loans, on their government issued debt. And so their credit worthiness is definitely not at the same standard as Swiss banks, Switzerland's debt, right? So suppose there's imperfect asset substitutability, which means that if I were to write UIP equation, there must be a additional term plus rho, right? And then I'm gonna write B TLT minus B CP. Where this term is positive or negative. So this is a CHF deposit. And I just told you that Euro is riskier, Euro bonds. So is rho positive or negative? negative, right? Positive would mean you need an additional return premium for depositing in Swiss banks. A row that's negative means that you need additional premium for depositing in European central banks. Negative. Okay, so there's two things to think about, right? Because if you conduct monetary policy with domestic or foreign assets, that will lead to potentially conflicting effects on exchange rates, if we recall from lecture, right? And we know that both Switzerland and European ECB, Swiss National Bank and ECB, can conduct OMO using either of these two assets. So let's walk through the consequences of buying domestic bonds versus foreign bonds. Okay, so for the EU, if they decide to buy the star, they decide to buy their own issue bonds. So maybe they buy Greece's bonds or something. That will actually increase rho, right? Because removing the bonds from the system, right, increases the credit worthiness of the European Union, and therefore will increase rho, right? It will make it less negative. But making it less negative will have consequences, right? It will actually increase E, right? Because if this is higher, right-hand side's higher, then I need to decrease the right-hand side, so E has to increase, right? The denominator. So this is at odds with the effects of the decreasing E from increasing an MS star. Agree? Right, because I increase MS star, it makes European Union euro, it makes euro weaker, which means E drops, right? But if I buy my own bonds, that will actually make me more creditworthy and have conflicting effects, right? So if I was the EU, I would probably buy foreign assets, right? Okay, so if I were Switzerland, SIWSS, if I buy domestic bonds, that will decrease rho, right? Because that will make me even more credit worthy, and rho will become even more negative. And that will decrease E, right? Again, but that will conflict. This will conflict with the increase in E from increase in MS. Right. So if you're from the Switzerland's perspective, you want them to buy their own bonds, actually, right? Because it means you don't have to print as much money because their expansionary policy is less effective now, right? From Switzerland's perspective, you want ECB to bail out that European debt, as it will dampen the appreciation of CHF. I hope you see that, right? . So obviously, if you're Switzerland, you don't want to expand your balance sheet by buying your own debt. You want to expand by buying foreign assets because that contradicts your expansion, your purpose of increasing money supply. So for sure, from Switzerland, you want to buy foreign assets. From EU, it's the same thing, but maybe from Switzerland, you can convince them not to do that because it has a less appreciative pressure on the Swiss franc. The last thing that was discussed was the Swiss franc as a safe haven asset. So my question is, how should the Ukraine-Russian war impact Switzerland's exchange rate? So the hint I'm going to give you is what happens to this, okay? What happens to this? So if you can tell me what happens to that, then you will know what happens to Okay. Safe haven, what does it mean? It means in terms of crises, in times of crises, more demand for Swiss francs. So if the Ukraine-Russian war just started, what happens to IHE? If E is defined as ruble per, sorry, CHF per ruble, Russian ruble. Let me just do it the other way. Sorry, let's do it. So Switzerland, ruble per CHF. So pretend I'm Switzerland, and I just heard news that Russia invaded Ukraine, or finally, incursion in Ukraine, and I know that in times of crises, safe haven assets are in high demand. What's going to happen to IHE? Given that E is defined as domestic over foreign. Yeah. If you said decrease, then yes, right? Gets super strong. So if E decreases, then A schedule will shift down. Right, because R greater than plus. So if this decreases, then I need to enlarge the right-hand side, so E has to decrease to match it. So the entire A schedule will go down, and then it's really bad for Switzerland's exporters, right? All right. So one last comment. If you look into this, it's interesting because I think there's some other countries that experimented with negative interest rates. I think negative interest rates only apply for Switzerland. Because it is a safe haven asset. And it makes sense. You want to punish the people who really treat the Swiss franc as a safe haven asset because they screw all the exporters. So it's like a tax, right? It's like a tax for treating the Swiss franc as a safe haven asset. Okay, let's take a 10-minute break. Let me circulate the attendance sheets, and then I guess I'll move more quickly for the other questions. Yep. Yes, open book. It's identical circumstances. Also, the slides. Yes, you can put the slides. This will be also on YouTube. Yes, I'm recording it, yes. Okay. Yeah. All right, folks, let's look at the last video I have for you. So this is a news report from a country called Namibia. It's a country just to the left of South Africa. But what's interesting is that their currency is pegged to the South African rand. Okay, so given that it's pegged, you kind of already know the problem. If their economy, I mean, if South Africa's economy is suffering, they have to basically suffer with them. And they basically have to implement the same economic policies so that there's a fixed exchange rate between the two currencies. All right, so let's give it a listen.
The three international ratings agencies have been monitoring South Africa's economic moves since last year. The country has previously avoided a junk status downgrade on 3 separate occasions. Now, less than 4 days after the sacking of now former Finance Minister Pravin Gordhan and his deputy Mcebisi Jonas, the country is running in panic mode. Gordhan has, over the past few years, worked hard to save the status of the South African rand, with markets and investors having shown great confidence in his ability to keep Namibia's neighboring economy from disaster. A local economist last week expressed concern over the political situation in neighboring South Africa, saying this could have serious impact on Namibia's economy, placing the Namibia dollar in trouble. A ratings downgrade will result in less access to credit and possibly an interest rate increase, which would affect many South Africans, making them to pay more to borrow money. The rand could also drop further in value terms, causing high inflation. In the worst-case scenario, it is feared that international investors may withdraw from participating in the South African economy. Timo Andreas, NBC News, Windhoek.
All right. So maybe his accent was hard to understand, but what happened was the South African debt was downgraded from investment grade to junk grade. And with that, I want you to analyze the impact of South Africa's credit downgrade on the exchange rate between the Namibian dollar and the South African real. Okay, and you do this with the AADD schedule. So let me write the relevant equation here. So with a credit downgrade, if there wasn't a row term, there's a row term now, right? That's what a credit downgrade is. There's a differential between the credit worthiness between two countries. And therefore, we have a row term which asks for a risk premium, right? On top of the return you get from South African bank deposits. So now that there's a row, and let's make this is Namibia. This is the country. And this is South Africa. South Africa. Okay. So if there is a credit downgrade, there's a row term and it's going to be negative, or if there was a row term to begin with, it's going to decrease, right? So decrease in row, which means that there's a decrease in E, meaning that the Namibian dollar wants to appreciate. Why? Because the entire right-hand side is now smaller. To elevate the right-hand side, E needs to move down to increase the right-hand side. So if you look at the graph, E versus Y, AADB schedule. Given that there's a credit downgrade for the same output. AA schedule must shift down, right? Because the lower, for every Y, there must be a lower E. Of course, this is not good news for their monetary policy because they want to maintain the peg, right? E bar. This is, let's call it E1. So the next question is, what can the Namibian government do to maintain the peg? The obvious answer is just simply shift it back. Of course, when you expand monetary policy, make sure to buy foreign assets, right? So option one is monetary policy, monetary expansion. All right, expansion. Expansion. Which means increase MS. The W foreign assets, right? The WCB. And then you can increase E, right? Which is what we want. Otherwise, there's going to be a appreciation, right? Or you can do fiscal contraction, right? You can do this, or you can, yeah, shift it back. Of course, I would not recommend it, right? Because you have to suffer even more. But anyways, that is an option. Fiscal contraction. Contraction. Anyways, it will achieve your goal of maintaining the peg. That would be, minus G, decrease G, or increase taxes, some stuff like that. All right, that's it for the TV stuff. Is there questions about this course and its relation to understanding news reports on the international things that occur between different economies? So hopefully you have a way now to kind of digest the news better. All right, so the last few questions are just, it's not as entertaining. This is just checking if you know how to construct option portfolios. So I have two questions two exercises for you. So we can do it fast because it's not that interesting. So here, obviously, the question I gave you on the exam won't be so easy. It won't be so simple. It will, of course, give you more realistic context because you'll be doing something for a company. Here, I'm just telling you, these are different types of option strategies that traders use to get specific exposure to either price, no change in prices or changes in prices. So the two, foundational strategies are what's called butterfly spread and long straddle. So I'll tell you why it looks like that. Basically, this one is betting that there's no change in the price, underlying asset, and here you're betting that there's wild swings in the price. The purpose of these exercises is just to walk you through writing out the payoff tables and plotting. Okay. All right, so a long butterfly option spread is a bet that the underlying asset or currency in this case will not move from its current price. So price stability or low volatility. So for the sake of this problem, let's assume that each call option is only for 1 unit of Chinese yuan, okay? And of course, they all have the same expiration date, so we can compute a payoff at the end of maturity in this case. So let's just work with European options, okay? Euro. All right, so here we have what I'll ask you to construct. E is defined as Hong Kong dollar per Chinese yuan, so here's E. I want you to long 1 call option with a strike price of here. So remember, this is the strike price, 0.11. Short, of course, not realistic, but anyways, just for the sake of exercise. Short 2 call options with strike price of 1.11, and then long 1 call option with a strike price of 2. So let's just plot a table, right? Let's do a table and then outline the payoffs in which the actual spot price is below 0.11, between 0.11 and 1.11, between 1.11 and 2.11, and above 2.11. Right, that's how we have to iterate over all possible states of the world, right? And we just characterize the payoff given that the spot rate, future spot rate falls between these intervals. So remember, I mean, I'll come back to these prices, but let me just write the table for you. This is payoff. Okay. Right, that's 1 strike price for an option. And then we have this scenario which is between a set of strike prices. And then we have another interval. And finally, we have ET exceeding the largest strike price. So I said long 1 call with a strike of 0.11. So if I'm long, I'm paying for it. So let me write C, but parameterize it with K equals 0.11. That means the payoff occurs only if the actual price in the future exceeds 0.11. So if below 0.11, then it's 0. Otherwise, my payoff is ET minus 0. That's the strike price. Right? So in all states of the world, that's my payoff. Okay. The other position is short 2 call options. The strike price is 1.11. Short means I sell them, so I get money up front. The payoff only takes place, the trigger only takes place if the strike is, if the spot price, future spot price exceeds 1.11, so that's here. So that I have to pay 2 times, minus 2 times ET minus 1.11. And the same thing here. And lastly, I have to I have to long one call option with strike price of 2.11. So long means I pay for it. It won't trigger unless the actual price exceeds 2.11. And so that's mine, sorry, that's ET minus 2.11. Right? Okay, so total. The total gross payoff. So this you can add up. I believe this should be negative. This is 0. This payoff is, okay, let me use okay, this is 0, right? 0 plus 0 plus 0. This is ET minus 0.11. This is, let's see, minus 2 ET, so I still have a minus ET, and then you have 2 minus 2.22 or plus 2.22 minus 0.11, which is 2.11, right? So this one should be 2.11 minus ET. And then this one, you have minus plus 211. That cancels out with this, right? That's gone. Minus 2t, sorry, 2.22 plus 2.22 minus 211 is equal to minus, we'll cancel out with this. And then minus 2t will cancel out with this. So this is 0. All right, so this is positive, right? And this is positive, so this has to be less than 0, right? So the graph will be shifting down if you incorporate the payoff today. So how does it look graphically? So what's important is the cutoffs, right? So let's do 0.11, 1.11, 2.11. So here it's 0.11. This is 1.11, 2.11. My writing is bad, so maybe I'll just do it again. Sorry. 0.11, 1.11. This is 2.11. Okay. Looking at the gross payoff to the left of 0.11 is 0. So that's just flat. To the right of 2.11, it's also flat. At 1.11, that's 1.11, that's a 1, or it's a, let's see. 11. Anyways, this should be a upward sloping curve. And this one should be a downward sloping curve. Again, you can verify that they will meet. Okay. And then if you will shift the curve down, if you incorporate the cost, right? This negative cost, the entire curve will shift downward. So that will be like this. Okay. I didn't tell you how much to shift down, so I could ask you, right, to specify how much to shift down. But anyways, this is what the payoff structure looks like after you shift the curve down. So there is you're basically gambling, right, that the price falls between this point and this point, which I didn't ask you to solve. And your payoff, or is bounded by these 2 points. Right? So that's a butterfly. Okay. questions on butterfly spread? So again, this is characterizing mathematically, right? This is probably the most informative graph. But if you want to kind of get the intuition of what you're gambling on, this is what you're gambling on. Right? You're hoping that the underlying asset doesn't deviate away from 1.11 too much. If it did, you're in trouble, right? Your losses are the cost, right? The cost of the option portfolio. All right. If no other questions, let's go over one more example, because I think this is the other stuff. I think swaps and forwards are super easy. So I think options is the more challenging one. So I'm just gonna do this. So a long straddle is actually easier because it's only two option contracts, one call and one put for one strike. So for example, if you want to gamble on war, if you expect a country to be invaded, for example, what you can do what's called long volatility. So what you would do is you buy one put and one call at the same strike price. So perhaps you're trying to exploit geopolitical activity in the Middle East. So in this example, let's buy options for one Israeli new shekel. So that's the currency in Israel. Of course, same expiration dates, but I'm going to long one call and one put, and they're at the money. So if E is defined as 2.8 Hong Kong dollars per ILS, right? Then I'm gonna buy one call, one put option at the strike price K equal to E. So let's do it. Let's do a table. Today, we have one case greater than 2.8 and another case which ET exceeds, right? I bought one of each, so minus C because I bought it, which means that I will get a payoff only if ET is greater than 2.08. I'll buy put, same strike price. My payoff only exists if 2.08 exceeds future spot price. And so my final position, therefore, obviously negative, right? Here, and therefore positive here. So we have just 2.08 and it's very simple, right? It's 2.08. So here we can see here is a downward sloping curve, upward sloping curve. So it looks like V, right? So if we were to plot this, this. So this is 2.08. You have downward sloping curve, upward sloping curve. There's an upfront cost, right? So the entire curve shifts down, which tells you exactly what the gamble is. You're hoping there's large swings down or up, right? Here and here, right? This is what you're gambling on. You're hoping that the underlying asset swings wildly, price. So if you believe they lose the war, collapse of the currency here, right? If you believe that they are going to resolve it quickly, maybe get stronger, I don't know. You don't care, right? Because you're betting on volatility. So you're hoping that whatever happens, it's going to impact the price significantly. Okay, so expect something like this on the final. So expect to have a design a portfolio to satisfy some objective be prepared to have a table, to outline a table, and be prepared to plot. Which shouldn't be too hard, right? All right. So the last two questions are super simple. 8 is just very, very shallow understanding of blockchain, which I think all of you already have a good grasp if you read the news. So let's go over it now. So remember, if I were to ask you anything about blockchain, it will be in true-false format. So I'm just telling you that's where you're going to see it. So let me read you this multiple choice question, which you won't see, but anyways, somebody can answer given this format. A government decides it will privatize vehicle registrations if the province's auto insurance companies can record and maintain ownership titles using blockchain technology. This application of blockchain is best characterized as A, a blockchain, B, tokenization, or C, smart contracts. So let's throw out an answer if you know it. Don't think too hard. So I took this from a test prep book for CFA. So just, yeah, tell me what you think it is. Nobody? There's only 3 options here, so. Sure, I think A is okay, but I think you can do better. Right, of course, everything is blockchain, right? We're talking about blockchain, but this is an application of blockchain, and the A is blockchain, yes. But of course, I think you can do better. So it's not this. It's this, right? You're trying to digitize an asset, and usually that's requires you to tokenize it, right? If it's fungible, then it's a fungible token. If you want to digitize art, for example, then it's a non-fungible token, right? So you must have heard NFTs, right? So that's just a physical asset or information that's put on the blockchain. So now we have license plates put on the blockchain. So we're just tokenizing information onto a database or public ledger. So the answer is tokenization. Smart contracts could play a role, but it's not obvious to me. Smart contract just means that just code that's executed automatically, as written. I mean, that's executed by the blockchain. But as far as I see, that's not what's going on here. It's just digitizing assets here or information. Okay. Second set, investors in an initial coin offering or ICO typically receive A, voting rights in the ICO issuer, B, cryptocurrency, or C, securities. Again, if you've been reading the news, you should know the answer very quickly. What do you guys think? What do you guys think? So an ICO is like an IPO, but you want to circumvent regulation. So that's the hint. You don't want to be regulated. So what can it only be without scrutiny from regulators? Yeah, it should be just cryptocurrency, right? If it was anything else, you're gonna be regulated. If it's this, regulated. Cannot have voting rights, for sure, no. Okay, securities, definitely no. Okay, so if you're gonna do ICO, you get some, they call it utility token that you may or may not be able to use to do something, who knows? Anyways, it cannot be anything else other than cryptocurrency, otherwise you'll be scrutinized. All right, lastly, what is a blockchain distributed ledger technology that can eliminate intermediaries in transactions? So remember, there's two types of blockchains, centralized and decentralized, right? So which technology, which option here gives you that decentralization so that you don't need intermediaries, you don't need banks? Maybe, but I think there's a better answer. So it's not B, right? It has nothing to do with it has nothing to do with eliminating intermediaries. Smart contracts, again, it's just automation of code. Just the blockchain executes code on your behalf. Something is triggered and code is ran. The blockchain does it for you. Now, the crypto part, right, is what eliminates intermediaries, right? Because cryptography prevents the need for centralized validators. You don't need banks to validate transactions. The only reason that's the case is because you have competition among the miners, right? The competition is what secures the blockchain. And that's only because there's cryptography built into the blockchain. So it's cryptocurrency. Okay. So the takeaway from these questions, is that Bitcoin's unique and it gives you that decentralization of not having a specific institution that manages the flow and transfer of money. Is because you have a competitive system of people trying to validate blocks and they get rewarded for it, right? And this is all done without somebody, some central planner, right? There's no banks, right? There's no government intervention. This is all done, right, through what's called proof of work. And it's the cryptography part, right? It's the cryptography part of the cryptocurrency that makes everything possible. Of course, there are centralized blockchains, but I'll leave that to you to look. I think IBM was working on this for a while. I'm not sure where that led to. Okay, last question, and then let's say goodbye. All right, so this is just review. I may or may not ask you a question like this on the exam, but remember there's exactly 2 questions, right? That's pre-midterm topics. So here I have you to do triangular arbitrage. But as you can see, you're missing a third exchange rate. And your question might be, how do I do triangular arbitrage without a third exchange rate? Well, the question is trying to be clever. I want you to be the market maker, and I want you to give me quotes for bid-ask spread, bid-ask quotes for the exchange between Canadian dollars and Japan, such that arbitrage is not possible. And so that's a kind of a reformulation, repackaging of a question that I asked you about identifying arbitrage. Here I'm telling you, well, you need to give me quotes that prevents arbitrage. So the question I have for you is, given these set of quotes, so remember, this is the currency you can buy or sell, right? This is the currency you can buy or sell. These are the prices in terms of Canadian dollars and Japanese yen. You need to come up with a quote for the price of Canadian dollars in terms of Japanese yen. Okay, and I want you to prevent arbitrage. So bid-ask spread just means I want the quote such that the ask minus bid divided by the ask. Yes, divided by the ask is plus minus 0.05% of each other, within each other. Okay. So this should be easy, right? Because if you know how to find arbitrage, you know there's just only two routes to check, right? There's only two routes to check. So I'm just gonna use this triangle here to tell you what to check. USD, Japanese yen, dollars. I check this route, right? I'll check this route. If that route doesn't work, then I'll try this route, right? But given these two routes, I can get some inequalities, right? That tells me what the bid and ask quotes should be for Canadian dollars and Japanese yen. So let me just walk you through it. So I'll put these quotes up here. Just do it together. So case one. I want to go US dollar to Japanese yen to Canadian dollars to USD. So let me borrow one USD. Okay. And I'm going to sell it for Canadian dollars. So I'm multiplying by the crappier price, right? So this price, it's a crappier price. This is, sorry, I'm selling Japanese yen first, sorry. So I'm going to sell it for this price, 11.9.8. JPY over. So I hope when I put it in quotes, okay, the USD is the denominator, just to avoid confusion. Okay, with Japanese yen, I need to convert it to Canadian dollars, right? I don't have that quote, so I'll leave it as a blank placeholder here. So if one CAD. I'm gonna start a new line here. Okay. So $1 times 119.8 times a placeholder, 1 Canadian dollar over ask JPY. It's ask because I have to pay the higher price, right? Times, once I have Canadian dollars, I can use it to buy the US dollars again, right? So when I buy at the ask, so it's 1 divided by 0.987 TD. And this one has to be less than 1, right? That's my inequality. So if you check, you should get 130.4 less than ask JPY. Right, that's one condition. Next two. We have US dollar. Instead of going to Japanese yen, then to Canadian dollars, we go to Canadian dollars first, right? CAD, then to Japanese yen, then to USD. So again, I'm going to borrow one USD. And then I'm going to convert it to Canadian dollars, but I'm going to sell it at the lower price, so 0.914. CAD, USD times, because again, I don't have an exchange rate between Canadian dollars and Japanese yen, I'm going to put a placeholder. If I have if I have Canadian dollars, I'm going to sell it. I think I'm I'm going to sell it for Japanese yen. I'm going to sell it at the lower price. So that should be the bid, right? Over 1 Canadian dollars. And then I'm going to take that Japanese yen, and I'm going to buy USD, but I'm going to buy it at the expensive price, right? So that's 1 USD divided by 419.86 Japanese JPY. which has to be also less than one, right? That's the other condition. So there cannot be any money machines here, right? There can't be a sequence of money conversions that gives me more than what I started from. And so I restricted that by setting it the inequality to less than one. All right, so if you simplify this, you will get of the bid JPY should be less than 130.51 per Canadian dollars. I'll write CAD. This is and so what I did is I just chose the bid as 130.4 and then plus 0.05%, which you'll find that it's actually less than 130.51. So I set the ask to 130.46, which is less than 0.51, right? So you can check, but that's it. That's all the question is asking you to do. So let me tell you again what I did. You're given two sets of quotes. You're trying to prevent triangular arbitrage. You're the market maker. You need to set bid and ask quotes. What are the conditions that you can define to give you a sense of what the bid and ask quotes should be? You can find that by looking at the triangle that I drew, because there's really only two cases to check, right? To test if there's triangular arbitrage. You go one direction and you go the other direction in terms of conversion. So you just do those sequence of steps, right? One way and the other way, and then set the bounds that prevents you from creating a money machine, right? You start with $1 and you get more than $1. So you restrict it, you're bounded by one. And you solve for the inequality, which is what we did. Well, inequality is what I found here. And just pick a number. For example, I just set bid equals this, and then pick a number that's within plus less than, like less than or equal to 0.05% of 130, right? Anyways, you get what I get. Oops. Anyways. All right, questions on we went over everything. Questions on the practice problems that I gave you? I think, again, the reason why I gave you these examples is I think you want to see a connection between this class and real world application, right? That the people having discussions about monetary policy, interest rate, exchange rates, this is the language that they use, which is the language of this class. If you understand the models, then all this is just clicking in your brain, right? When they're speaking. And a lot of times they say something that's wrong, and you can figure it out with this framework. And also, I think this is what most people struggle with in this class, which is why I gave you. The other stuff, I think, is just takes practice, getting used to, but once you see enough, then it should be automatic when you do the exam. Okay. All right, so let me conclude this class with the following. Of course, the takeaways, yes, but I hope you learned something from this class. That's what I really, ideally, people walk away with this class feeling that they learned something at least, and then they are closer to industry, right? In the sense that you understand the language better. And I hope you keep using this in your whatever jobs you end up taking in the future. So if you haven't taken the LOQs, this is something new. I think they started. So please take some time to fill it out. It's important to give feedback. Otherwise, I don't know how to improve this course. So if you can, please take the time to fill it out. Otherwise, good luck on your final exam, and I'll see you, well, see one of the sections, okay, on the final exam. Okay, all right. See ya.